Hey, I wanted to go over how to create a trading plan. So having a solid trading plan is a key part in becoming a trader and being consistent as a trader. And there's multiple different things that I'm looking for when I'm creating a trading plan, and we're going to go over them right now. And, none of these are in order, but let's just start off with the first one being risk to reward. So when you're looking at trades, we want to have ourselves set up for success. And many people, when they first start to trade, is a lot of the wins that they're making, they're pulling out early and they're holding on to the losses, hoping they go back in the right direction they're hoping for. But a lot of times you can get away with this, but there's a time when it's not going to happen. They're not going to let you get away with it. And that's when you're basically just going to drain your account. And it's so hard to stay consistent if you're not using risk toward ratios in your trading. Basically, let's say someone is making $500 a trade and they come into a loss of $2,000. Well, what would happen is they would need to make 4 trades back just to break even. And those 4 trades would have to be wins in a row, which a lot of people, if they're not even using a risk toward ratio in their trading, they're probably not very serious about it, and it's going to be pretty impossible to get that back. So what we do is we set up a risk toward ratio that helps us stack the cards with us. So basically, we're going to use a 1-to-3 risk toward ratio at least per trade. This means for every 1 trade, we're getting a 3 times return on whatever we're risking, right? So if you're risking $1,000, you're trying to make $3,000. And the best part about this is, like I said before, if you make $500 per trade and you lose $2,000, you're going to need to make 4 winning trades in a row to break even. And with this is, you can lose 3 trades in a row, win back 1, and you cover all your losses. So this is a way better way to trade, and we use at least a 1-to-3 risk toward ratio, and I would even prefer a 1-to-5, but it doesn't always happen. So using a solid 1-to-3 risk toward ratio is key, at least when you're getting into trading, and also this will help your decisions. So like when you're not really thinking about a risk toward ratio strategy at all, usually what's happening is you're going to be more indecisive about trades and just kind of hopping into something if you see a short-term move. But the problem with that is, why would you risk $300 to make $100, or why would you risk $1,000 to make $300? Right? It doesn't make any sense. So we want to have ourselves set up so we have a much farther reward than our risk. So this is how we're going to achieve that using risk toward ratios in our trade. And whenever you look at trading setups, you're going to, pretty closely, you're going to start narrowing out the bad trades and only pick the good trades. You're going to be focusing on much higher quality trades rather than quantity, which is going to be a much better thing. So going into the next topic is going to be strategy. What do you like to do? Do you like to scalp? Do you like to day trade? Do you like to swing trade? Whatever you like to do, whatever fits your lifestyle, whatever you're the best at, whatever, angle you're looking at it from, pick one. And once in a while you can play around with others, but I like to just stick, for example, for me, I stick to day trading. Most of my moves are on the Dow are around 100 to 200, 300 points or 2,000, 3,000 pips. And with scalping, swing trading, there is a time and place for it. But again, it's not always. I mostly just day trade, and then once a month maybe I'll do a scalp or a swing trade. So the next topic is going to be pairs, stocks, crypto, indices, master 2-3. So what I mean by this is everyone wants to be the jack of all trades. Everyone wants to be a crypto, a stock, everything. They want to do everything underneath the book, and you're just not going to, really have the success that you want with this. If you look at all the high net worth individuals, they basically do one thing and they do it really good. With that, after they hit a certain point, they just start to diversify. You don't need to be a jack of all trades right now. Focus on 2 to 3 different stocks or indices or cryptos that you want to trade on a daily basis and master those. Become a master at those 2 or 3 different stocks or indices. And after you do this, I like it better because I'm not bouncing around trades. Also, you have, especially when I'm trading US 30, I'm trading it almost every single day. I can look back on my prior analysis the day after, the day after, the day after. But the problem is when you just jump into a stock or jump into a crypto that you've never even really been trading in, you're not going to know the whole backstory. You're not going to know all the situations that came while you're trading. And also, I think, again, this comes with making quality decisions over quantity. You don't need to be looking at 10 different stocks at a time. All you need to do is master 2 to 3 a day, make 1, 2, 3 trades max per day. Usually I'm only making about 1 or 2 trades a day on these. So the next topic is going to be, what time are you going to trade? And every day, question mark. This is just, I like to trade. I have certain time frames that I like to trade in during the day, and you're going to see different times that you like to trade in. I like to personally trade open, New York open, and there is some times when I'll trade power hour, or I might even trade some London session. But you can be flexible in your time frames, but really try to trade in each different time frame multiple times and see what you enjoy the most. Also, you don't have to trade every single day. If there's not a setup that day, then you don't have to trade. Don't be rushed into thinking that you have to make a trade every single day. So the next one is going to be determine how many confluences you need to enter a trade. So with this, basically a confluence is, let's just say you're looking at a chart and you see a certain pattern, and then you look at the RSI, it's in your favor, and moving average is looking good too. That would be 3 different confluences, and those confluences would, lead you to believe that this is where a trade's going to go. So many people just go into a trade with one confluence, and that's not the way to do it. Just because the RSI or the moving average is somewhere on the chart doesn't mean that it's an instant buy or sell. You really need to have multiple different confluences while you're trading, and I usually look for at least 2 to 3, and that's a good area for me, but everyone's different. Some people like to have more confluences, and some people don't. So you have to determine that on your own. And like I said, if you have to, just trade on a demo or trade with a smaller account type, because once you can use one of these accounts to practice on, you can, do a couple trades, do like 10, 20 trades, and just write down each of the confluences that you had and determine, do I really need 5 confluences to enter in a trade? This is all personal preference. This is up to you. So, and everyone trades differently too. Everyone sees some of the confluences differently. I don't read the same chart that you do. Everyone looks at it in a different way. So what time frames are you going to trade on? So with time frames, basically, I use multiple different time frames. Most people should. I use H1, H4, and then sometimes I'll dabble into like an M30, maybe an M15. But most of the time I'm staying in these higher time frames like the H1, H4, M30. And some people, if they're going to be scalping, they're probably going to be using M1, M5, M15. And if they're going to be doing more swing trading stuff, they're probably going to be using, H4, day 1, etc. So figure out what time frame you're going to use, and that's mostly going to correlate with whatever trading strategy style that you're using. And the next one is going to be exit strategy. So this is really important too, because it's not even about when you enter in a trade, because at some point you're going to have to exit. So exiting is a very big part of trading, because this is how you're going to secure profits. So you need to figure out your own exit strategy. There's multiple different types of exit strategies that you can use, but you just need to figure out which one is best for you. One that I'm dabbling in right now is basically once I hit a 1-to-1 or a 1-to-2 risk toward ratio, I'll move my stop loss to break even. I'll let it ride, and once it goes over a 1-to-3, I'll usually watch out for a little bit and eventually move my stop loss to 1-to-3 risk toward ratio. Then I'll let it ride out, and if it hits a 1-to-5 or a 1-to-7 or something, perfect. But if it goes back to my 1-to-3, I'm fine with that. So that's what I've been using, but you can use whatever strategy that you'd like to do with your exits. And the next one's going to be lot sizes. So, you need to figure out how much percent you're going to risk per trade. Then you're going to figure out what lot size that is with basically your account size. And also you need to determine what's going to be your stop loss levels for these trades. So when I'm trading indices, basically I'm going to be looking at 300 to 500 pip stop losses, 30 to 50 points. So you need to figure out what kind of stop losses and what kind of lot sizes you're going to be using. This also all correlates with your risk toward ratio. But another point is going to be, how are you going to track your trades? Because each trade, you should have a journal or you should have a log that you can basically look at previous trades and see what happened. Write down the confluences, write down your exit. Why did you exit? And after a while, you're going to have a trading log, and you're going to see after months and months, your results. And when you do this, you're going to be able to look back at your results, and you can back test and look at the chart, see what you could do better, criticize your plan, because your first trading plan is never going to be your last. This is just a start, because each win, each loss is going to start to critique your own personal strategy. Another one is going to be, when do you plan on extracting profits, right? Do you want to keep, using that one account and just keep loading it up, or are you going to start to extract some profits? Are you going to put it in your savings account? Are you going to buy something with it? Are you going to put it into long-term holds, whether it be crypto, indexes, or mutual funds or stocks? Whatever you're going to put it in, you need to have a long-term plan as well, not just like your short-term day trading, scalping plan, whatever it is. You need to have a long-term plan with this money, because the best thing you can do is, once you make profits with this, the best place to put it in would be to throw it into other assets, preferably. Then you need to perfect your plan. And this just goes back to what we were saying before with criticizing your plan. Each win, each loss, you're going to see things that you did right, you did wrong, and every single time that you go through your trading plan, you're going to have to critique it little by little every single day. Then the last point I want to talk about is going to be consistency. And the more chart time that you have, the more consistent that you're going to be, and the better your trading plan is going to be, because you're going to be able to critique it, just like I said before. And as time goes on, you get more chart time. I mean, just think about, having 10,000 hours of chart time or more. Once you're at that level, you're going to, your plan is completely going to change. And hopefully by that time, you'll be way more consistent, because you're going to go through, over hundreds of trades, and you're going to have all this logged, and you're going to be able to see what happened. And if you could critique it right, you look at it from a point of view from, if I look at this trade and I can figure something out from it, if I can critique it, if I can, if you can learn from your losses, learn from your wins, then you're going to be a whole lot more consistent than the people that go into trading and just kind of half it, and basically just go into all your trades and not writing all these down in the log, not critiquing your strategy, not going over the losses, not going over the wins. The people that do this are going to be way more consistent in the long run.